Well, hi everybody, this is Dr. Keith. How's everyone doing today? Happy Tuesday. Hope you all had a nice long weekend. Get some relax. I know I did. All right, so I'm looking forward to today's presentation. As I mentioned, going into late last year, I'm going to do more of these educational type webinars. I get a lot of questions on how I play options, and I've got some very simple methods. And you may look at these and think, well, wow, they're very simple. What is he really doing? And this is how I trade, folks. Remember, the real power in my trading is the seasonality aspect, the high probability moves. It's just a matter of formulating strategies then to make money, right? Again, I don't need 20 indicators. I don't need complicated process, and nothing I do, in my opinion, is complicated. Okay, so with that, again, we're going to focus today on stocks, and specifically options, and then how I trade options with stocks. Okay, I know it's very popular. A lot of you trade maybe all three markets. Some of you I see on there definitely do, but today we're going to really focus on the option side of it, trading stocks. And I don't think this will be more than 45 minutes, folks. Okay, so it could be a nice short and sweet, give you some ideas, and then move on to the rest of your day. Okay. Okay, so I assume you all can see the slides. So if for some reason you can't, shout out. But I'm definitely thinking that you should be able to see my overall screen there. Okay. Okay, so first and foremost, again, folks, there is risk in trading, as you all know. You should never trade with money you can't afford to lose. Not only from a legal standpoint, but again, just as a person, if you try to trade money that you need in order to pay a bill, okay, your psychology is not going to be there either. Okay, so only trade with money you can afford to lose. That's one. If you can do that, that's a way to build up your account and be successful. Okay. So today, again, it's going to be a fairly short agenda, and then I'm going to go into live charts and show you around a little bit on what I do. We're going to talk about trading options, and again, I've got to put with seasonality because that's the only way I trade. But the two main concepts that we're going to focus on today is doing straight calls and in theory puts as well. Okay, but we're going to focus on longs right now because I feel that we're still in a bullish market. And then debit spreads. Okay. So just to make sure, again, can you just type a 7 in the chat box if you can hear me? Just want to make sure before I continue on that everything is clear. Perfect. Thank you. Thank you. Okay. So again, I'm not going to go too much into my intro because most of you know me, or if you don't, you can watch some past recordings. But the bottom line is, ever since 2006, I started doing research in one of the universities that I teach for, and started getting extremely excited about some probabilities. And again, back then it was way more difficult to find seasonal moves, than it is nowadays. Okay, so based off of these seasonal moves, okay, that's how I began to learn a successful way of trading. I live in Central Oregon on the West Coast. And the reason why my number one trading is swing trading is because of lifestyle. Okay, I do not personally want to be in front of the computer all day. As much as I love trading, again, I probably love it more than just about anybody. I also prefer my lifestyle, spending time with my family and my kids. That is why I swing trade, and have been doing so for many years. For some of you that are new to these webinars, let me just briefly explain, first of all, what seasonality is. Bottom line is any predictable change or pattern, okay? So any predictable change or pattern in a time series that recurs over and over again. So something that happens over and over again, year after year. And why do they do it? Because producers, consumers, traders, hedge funds, Fidelities of the world, they do it because that's what they're used to doing. And if a strategy worked in the past, they're going to do it in the future. Okay? And why do a lot of hedge funds buy Apple stock January and February? Because they do. Okay? Year over year over year. And again, you don't have to take my word for it. You can go back and back test yourself, or obviously I've got a lot of tools in my toolbox that gives you that information, okay? But the bottom line is, no matter what you trade, almost everything's going to have some seasonal pattern, whether it's once a year or 5 or 6 times a year. Some stocks have phenomenal seasonals multiple times throughout the year, okay? It's a great time to really give yourself that edge, okay? Why go short in a particular trade that's gone higher 40 out of 42 years during a certain time frame, right? And that's really why I'm trying to get it out to everybody and educate is, I'm not saying you have to go long during that time period if you're not feeling comfortable, but why the heck would you want to go short, okay? So that's seasonality, big picture. Okay, so debit spreads, folks. Let's talk about them, okay? They're not complicated, and when I show you on Thinkorswim here in a few minutes, you'll see. Okay, again, I have a very simple philosophy though. I like to trade debit spreads that have a dollar spread. Some will have 50 cents, and you can do 50 cents. I prefer to break it to $1, my personal preference. 250 spreads or $5 spreads. Some even have $10 spreads. I tend to stay away from those. My favorites are definitely the $1 and 250 spreads. And what I try to do is get roughly half the spread or cheaper. So for example, if I'm doing a trade where it's a $1 spread, let's say I'm buying the 43, okay, selling the 44, and they're trying, it's a $1 spread, and you'll see it again in live examples, okay? So if you have that $1 spread, I try to get filled at 50 cents or less most of the time, okay? The cheaper you get filled, the more opportunity, because you want that spread to actually rise, okay? And that's true whether you're doing a debit spread, a debit put spread, or a debit call spread, okay? Now I get a lot of questions on, well, Dr. Keith, how many weeks out do you like to look at, okay? And typically it's 3, but the reason I'm putting 3 or 4 weeks is, one thing to notice is when I'm doing debit spreads, my goal, folks, is to make a profit quickly and get out, okay? It's all about income generation. It's not going to be I'm making a 200% return, okay? You can on debit spreads for one, but the goal is based off of good seasonal moves, triggers, okay? Let me get in. It doesn't have to move as much when you do a spread. You can get your profit and get out, okay? That, first of all, is my overall goal of these, okay? Now, the reason I like to go 3 to 4 weeks out is because that's typically a good seasonal move. I'm what I'm looking at, okay? If it's a 1 week seasonal, I probably won't do those, okay? If it's a 6 or 8 week seasonal, I can do it. The longer the seasonal, then I like to do straight calls as well, which again, we'll talk about here in the next few slides, okay? But the bottom line is I say 3 weeks, but if you go 4 weeks out and you're getting almost the same price, you might as well take the extra week, right? Because then you don't have time to keep getting you as much. So again, I'll show you an example of that. But the bottom line is it really will depend on your risk tolerance and where you're at. If you feel you're getting a better deal at 4 weeks out, then go 4 weeks out. Okay. So again, some of the advantages, when you're expecting quick moves, you can make, my strategy is I like to make about a 50% profit and then get out, okay? They're also cheaper, right? Getting in at a $1 spread at 50 cents, if you're doing one contract on that, you're risking $500 if you let it expire, which I never do, okay? Okay, so smaller accounts can now start trading these. And if you have a larger account, you can multiply the contracts, right? And again, as I mentioned, it's really about building income. And that's why as part of my alert service, I do quite a few debit spreads because it's about building income so that then you can go for some more home run trades as they present themselves, okay? Okay, so let's talk again about doing straight calls. And again, I know I'm keeping this extremely simple because this is how I trade. And I'm also going to show you live chart examples that will then put this together. Okay, I'm not going to just show you these slides and the presentation and say have a good day, right? Probably wouldn't make any sense then. So I'm going to show you on some charts. So when I'm doing straight calls, I like to look at my seasonal indicator, okay? And if I see a potential opportunity that's got a 3, 4, 5, 6 month move, okay, then I like to do straight calls. Does anybody have any idea why? So what is the advantage, one of the main advantages doing a straight call versus a debit spread, a debit call spread? Yeah, you have unlimited opportunity, right? If the price continues to go up with a straight call, right, you can make a 2, 3, 4, 500% return, right? With a debit spread, the most you could make would be 100%, okay? 100%. You got it right. You got it, Alan. So again, it's going to make sense how I do it when we get to the live charts, okay? But does price have to go further typically with straight calls versus spreads? Absolutely. Okay, and typically you're putting on a little bit more initial risk because it's going to cost you more, okay? It's going to cost you more. But then all I do is I really try to look at the money, okay? And if the volume is pretty similar on let's say the strike above and the strike below, I'm going to go up right around the 50 delta, okay? Now you might say, well, why, if you think the move's going to go higher, why don't you go to higher delta? You can, okay? There's not a science here, but it'll cost you more, okay? So if you go in at an 80 delta, it's going to cost you more. So that's why I like to keep it pretty simple, especially for my alert services, so that you can get in as cheaply as you can, make a good return, get out and build up that income, okay? So again, advantages, you can go for that home run, okay? For example, we did the gold play that we're still in back in December, the GLD ETF, right? I think we're up around 90% right now, something like that, depending on what it's doing right as we speak, okay? If I would have did a debit spread, I would have been out a long time ago at a 50% profit, okay, which is still fantastic, right? We've been over 100. I think at one point we were up 120% on the straight call on GLD, okay? The reason why I'm not out yet is because I'm still waiting for that second push up, which I think is going to happen, okay? So if I can get 150% return, let's say, I'm going from maxing out at a 50% with my strategy on the debit spreads to 150% on the straight call, okay? Both good strategies, but when I see a high probability 2 to 3 to 4 month play, if I can afford it for my audience, especially for the alert service, I'll do straight calls because again, we can make more potential earnings, okay? Okay, so I'm going to go into live charts here. One of the data mining examples that I have, so AON, which is AON PLC, okay, it's gone higher 34 of the last 35 years coming up here, folks, okay? So think about that first of all. Let me bring up my Thinkorswim, come up here on AON. All right, let me just make sure. Al, can you see my Thinkorswim screen? Just want to make sure everybody can see what I'm talking about here. All right, perfect, perfect. Okay, so let me explain something here first. Grab my marker. So first and foremost, This chart here, I labeled number 1 is my seasonal chart. I use the weekly data for my seasonal chart, okay? So this is current price right here. The dotted line then is the forecast off the weekly. So you can see what I'm trying to show you is we're basically looking at going higher substantially now, okay, until into March, right? Does everybody see that? So if I were to show you, if I draw the line from right now till that peak, that initial peak, it continues higher, you can see, but let's just talk until March, okay? You can see that during those 8 weeks, it's averaging about a 7.5% move on that stock, which obviously means a bigger percentage of money being made on the option side, right? And from my data mining, I know from 126 to 415, the last 34 out of the last, I should say 34 out of the last 35 years, the move's been right around 8%, which is what is shown on my indicator. Okay. Now my indicator, I'm going back 10 years though to show the most recent 10 years. My data mining showing out of the last 35 years. So this is a pretty typical move, 8% or so, right around now. Okay, until somewhere in March to April. Okay, and so nothing should be surprised here. What we're looking for at this point, though, to show you is, I want to look for some sort of a pullback, right? I don't want to just go long here. I'm going to wait for my trading system to tell me when to go long, right? We're at a recent high here, so I do want to see a pullback, okay? But what I wanted to show you here is, so from a data mining standpoint, I know we have a high probability trade coming up. So let's practice, okay? So how should I trade this? Well, let me show you. So there's a couple ways, right? If I'm going to do a debit spread, okay, we know we got plenty of time. So let's go to the trade tab. Okay, we don't have weekly expirations for AON. Okay, so I can only go 31 days. So that makes it easy on the debit spread. I'm going to look out 31 days. Okay. Now, open interest is right here on the call side, and this is what I'm talking about. I roughly like to go right in here to make my trade. Okay, this is showing a 21 delta. Okay, because this isn't a weekly expiration. This is showing a 56. Okay, there's a lot more volume on the 21 delta, which in this case, because it's much more significant, even though we're not going to get as much of a move, right? For every dollar it moves 20 cents, okay, we could still make some really good money on that if we were doing a straight call. But in this case, we're looking to do a debit spread, okay? We're looking to do a debit spread. So I like to go right in at the money, but in this case, so it's usually here, but because the volume is so much higher one below it, okay, let's take a look at that and see. So I'm going to right click on Thinkorswim on the call side and buy the vertical. Okay. So again, this is a $10 wide strike. I don't trade a lot of these, but I just want to show you from a standpoint of how you can do this. Okay. So if it was what I was looking for, if I'm doing a $10 strike, and we'll go over dollar strikes as well. Okay. Okay, this is a $10 spread. I'd want to get in for $5 or less. Okay. Right now it's giving us $1, which is really good. Okay, which is really good. Okay, so I'm not ready to get into this yet, right? I don't even have a trigger. But if I was, okay, this would be acceptable, right? This would be a really good entry at $1. So you're basically, if you were to do something like that, okay, what that's going to show you is your break even is at 221, your max profit is 9,000, your max loss is 1,000, okay? And again, we wouldn't be staying in this trade. We'd be trying to achieve half of that 9,000, then we would get out, okay? So then the other option is this. Again, knowing that, hey, this thing could have had higher for quite a while. Okay, we keep going up, we top in June. But let's say, again, you say, all right, well, I'm going to take this until June. So I'm going to look for a July expiration straight call. Okay. So I'm going to go out to July. This is going to be expensive, right? Because of this particular stock. But I just want to show you the options on this one. Okay. Don't worry about the individual stock right now. Think concept. So if we were to get I would probably take the 39 because the volume is a little bit higher. I like to, in a perfect situation, 200 contracts or more is good. So I would take this one and I would buy the single. Okay. And I'm not usually too picky when the price, once we get in there, maybe 650. Okay. So it's costing you 650 to get in versus the debit spread was costing you $1, right? But the difference is once you're making money on this longer move, right, there's an unlimited potential, right? This thing could go up, if this thing were to go up to 250, 260, which it certainly can between now and, now in June, July, when we're looking at that, right? You can make yourself a lot of money. So we're going to go over 3 or 4 examples today, but I wanted to show you potential trade that moves much higher typically year over year on that one. Okay. Now let's go over to Visa. You can see we hit new highs today on Visa. And let me just show you a couple things on that first. So when you're looking at Visa, let me show my seasonal indicator first. This white dotted line, okay, this was what it should have been doing back in September, October, November, December. This was the forecast, okay, what it should have been all the way up to right now, okay? So what I'm showing you is once I get into September on Visa, see right here, September 16th, that week, I really look for longs on Visa. Does that make sense? Okay, so let me shrink this back up for a minute. So if you go back to September where I drew this green line, okay, I got a trigger on October 4th. Okay, so this is when I would have got in Visa with my rules. Okay, right here, okay. So it went sideways a little bit. We had earnings. So again, you have to remember, either wait until after earnings or take the risk into earnings if you're not going to get out beforehand. Okay, again, I don't want to overcomplicate it today. Let's just stick to the technique. So if you got in, there's this high probability seasonal trade. Okay, you can make money on this whether you're doing a debit spread or a straight call. Okay, but again, let me show you how. So if you go to the trade tab, I'm going to go to analyze, and I'm going to go to think back. Yeah, I want to make sure you all see that. Think back. Here's one thing I like about Thinkorswim. You can go back and see what something was back in time. Okay, back in time. Bear with me here. Okay, so I'm going to go back to October. Let me see, what was that? October 4th. So on October 4th, hey, we're on October 4th now. This is a live data from October 4th, if that makes sense. Okay. If I was looking at doing a debit spread, right here, remember we want to go right at the money. So right here, you want to buy the vertical. Okay. And if you were doing that, if you're going to buy the vertical here, grab that over. Right here. Okay, it's going to give you then from that vertical, it's not letting me right now, I think because the market's closed right now. Okay, but it's going to give you that spread. Okay, that debit spread. Okay, and then what you want to do is, well, let me apologize. we got in October, we'd want to go out right around here, 28 days, November. Sorry about that. Okay, remember, we want to go out 3 to 4 weeks, so 28 days, okay, and then that's when you would get in here, okay. It's not allowing me to, I think, because the market's closed. I apologize. But anyway, based on that spread, okay, you would get in, and as long as this is a 250 spread, okay, you can say by the strike prices. So it's a 250 spread. We want to get in at $1.25 or less, okay. So if we got in, let's say at $1.25, okay, which is what that gave us at that point in time, okay, then we can get out when we get a 50% profit. And how do you do that? Very simple. Get your calculator out, type in 1.25 times 1.5, okay, and then you could get out at, put an order in once you get filled, put a limit order in at 188. Once price heads up and it heads up to 188, you get filled, you made your 50% profit, okay. If you go back and look at your charts, we got in here, right here. Right here is where you made your money, okay? Right there. Now, you made 50%, you're all pretty happy. But what if you wanted to do a straight call? You're like, well, wait a minute, this thing goes for a few months, so I'd rather just stay in the trade longer, okay? It's gonna cost you more, right? But remember, if you go back to your analyze, think back in time here, let's say you did a December expiration, right? Let's say you're saying, okay, I'm gonna, well, actually, let's do a December expiration because it expires. The recent top there is right at the end of November. Okay, so you go back here, say, okay, I'm gonna do a December expiration, right about at the money there. You know, and you're gonna buy that single. Okay, and again, it's not let me do it right now. But what'll happen is it's gonna cost more, right? But then as this move happens, okay, you can eliminate some risk, and we, you know, right here is expiration right here. So you would have made double your return on this particular trade, knowing you have this high probability Visa long from September till the end of the year. Okay, so that's why when people ask me, why do I do debit spreads sometimes? Why do I do straight calls? I like to know based on the seasonal and how expensive something is. Okay, so that no matter what size account, you can trade those. Okay. Let me bring back open the slides there. Okay, so what I'm going to do now is let me give you some ideas. Right, I want value added for every time I do a webinar for you all. So let's look at some opportunities here. All right, Broadcom, right? I talk about this quite a bit, and there's a reason. I love trading it, right? So as you can see here, I'm getting a trigger here, and the Laguerre triggered at the close of today. So this is a good potential opportunity from the daily, as long as it's matching the season, right? As long as it's matching the season. So we go forward to the line right where we're at, and you can see this is what it should be doing until March. Okay, so we had this nice pullback to the bottom Bollinger Band. Now we're getting triggers long with all this room to make money. So what do you think? Is that a good looking opportunity? I think so, right? So a couple ways to trade that. Okay, you could do a May expiration, straight call, or you could do a 3 or 4 week debit spread. Okay, well, let's just take a look. Okay, remember, this is for educational purposes only. I have to state that. Okay, so if I'm going to do a debit spread, let's take a look at 24 days out first. Okay. Okay, the spread is 37, not too bad of a spread there, but if you see here, right at one right outside the money there, right, has a lot more volume. See what I'm talking about? That's why, this is the rule right here to get in right at the money, but I'll deviate here or here. In this case, I like the 1740 volume, okay? So if we're to right click, buy the vertical, okay, remember now, this is a 250 spread. You're buying the 310, okay? You're buying the 310 and you're selling the 312. It's one transaction, okay? So it's a 250 spread. So what do I try to get? $1.25 or less, and it's giving me that, okay? It's giving me that. So again, if you were to confirm this, it's basically telling you your break even is 311.10, your max profit is 1440, your max loss is 1100. So again, it doesn't have to move as much in your direction to make your profits and get out. The disadvantage, the most you can make, no matter how high this went and you kept it, is $1,400. Okay. But as the move happens, you're going to make money faster on that. Right. And again, remember, you're buying the vertical at $1.10. One contract, so let's say you got in at $1, is $1,000, right? Okay, one contract would be $1,000. So for $1,000 investment, okay, you can make maybe a potentially quick 500 bucks. Let's say we wanted to go out and do a June expiration on this straight call. Okay, so I'm going to click on the June. There's plenty of volume here on either one, so I'm going to stick right at the money. Let's go to the 50 delta and buy the single. So the 310 call is costing 20 bucks, right? Broadcom's expensive. So one contract is going to cost you $20, right? Again, some of you may not be able to afford that. The debit spread's a better bet, right? Again, max loss is $2,000 on that. Okay, so if you're risking $2,000, right, the difference is if that thing goes up like it can from here, from right now, look at that. 10% on the stock itself, okay, you could get a nice 100, 200% return on this option play, right? That's how you grow accounts, knowing these highest probability. Okay, so nothing's guaranteed, right? But when you're looking at this trade, if you were looking at shorting this, the odds are definitely against you, right? And that's how I use seasonality to stay out of trades as well. The staying out of trades is just as important as taking good trades, right? So I'm expecting Broadcom to head up here over the next few days, right? Obviously, every day, no. It's not how the markets work. It could even retrace again, okay? Although, when you have a Laguerre trigger and a stochastic within 3 days, okay, it works out pretty nice. Right here, bam. Okay, so I really like Broadcom right now. Oh, let me give you some other opportunities. So Lulu. Okay, let me explain my seasonal indicators. So the white line is the forecast, what it should have been doing. Okay, back in time, November, let's say. And price has been doing exactly, I mean, it's been following it to a T. Okay, so what am I expecting on Lululemon? I'm expecting to come higher and top right around April. Okay, in fact, from right now until the week of April 6th, 13% move, right? That's a pretty big move on the stock. So think about it from an option perspective. Okay, but again, I don't just take these trades. What I'm waiting for now is a pullback to give me a re-entry. Okay, the last trigger we had, because remember, looking at that white line, we should have been going long a while ago. Okay, we had a nice entry on Lulu right here, right here. Okay. So I know some folks are already in it and making their money. A beautiful trade. Beautiful trade. But anyway, I wanted to bring this up. Keep an eye on it. If and when we get a retracement, Lululemon's a good long play coming up again. Okay. It's also in that nice dominant uptrend. We all know the trend is our friend, don't we? All right. Let me give you a couple more. Domino's. So Domino's Pizza gives me a stomach ache. Okay, I'll be the first one to admit it. When I was a kid, it was fine. But now it gives me a stomach ache. Okay, but this is definitely a seasonal Super Bowl play. Okay, right about now, and one thing I love about this, folks, look at that support right there. Right about now, until right here in March, Domino's heads higher. Okay, so I know how many of you typically eat Domino's pizza during the Super Bowl. I know, right? So anyway, again, average rise is around 17% the last 14 out of 15 years, starting right about now. Okay, so keep that on your watch list. Whatever your triggers are, you better believe my alert service will be getting a trigger on this soon. So what am I waiting for? I'm waiting for another stochastic move up, and more importantly, my modified gear to give me the long trigger. I love where price is right now. If we get an up day or two, this thing is going to give us a good opportunity to make some money on Domino's. Okay. So let's say we were taking it right now, just again show you the different types of trade. Okay. So again, if you're going to do a debit spread on Domino's, okay, let's go 24 days out, 3 weeks, a little bit over 3 weeks. Right at the money. Okay, again, right at the money here. I'm going to right click, buy the vertical. It's a $2.50 spread. You see that? And it's still giving us a good price, $1.20. Okay, $1.20. So that is equal to or less than $1.25. I will take it. Okay. If I got filled at $1.20, I would put a limit order in once I'm filled. Say, okay, $1.20, 1.5 of that is $1.80. I'd put a limit order in to get out at $1.80 and make my 50%. Okay. Conservative way during big moves to make some money. Well, let's say you want the home run. You look at this chart from a seasonal and you say, well, wait a minute. I watch Rocky. This thing is going to go higher till April, end of April. So I'm going to do a May expiration. Okay. Delete that. So there's a June. So let's do a June. Again, you're just buying the single. You get the 280 call for 22 bucks. So again, you're risking $2,200 again, folks. Okay. But the odds are if this thing moves up 17% from an option standpoint, you're going to get double-digit returns. Okay. And there's a lot of them out there that are dollar spreads. Okay. So you're not risking as much in your account either. But one contract, if you can risk $2,000 roughly to make 4 or 5 potentially, within 2 or 3 months, right? We'll sign up for that all the time. And again, from a data mining standpoint, 14 out of 15 years has gone higher, specifically right now. Right now. Okay. Now I know Tom Brady's not in the Super Bowl this year, so we'll see if it continues its seasonal pattern. If it doesn't, it's because Tom Brady is not in the Super Bowl. No, that's not why. They got Mahomes, right? Okay. Let me bring up Netflix. Okay. So we just had earnings tonight, right? So now we're clear. We just got out of this. We made a small profit because I wanted to get out before earnings, okay, on this trigger here. But now I want to get back in, when it gives me the opportunity, okay, when it gives me the opportunity on Netflix, right? Because we know when we're looking at the seasonal side, You see all this green, folks? That's what you can hopefully make. So from right here, where we're at, to the end of June, oops, Netflix goes up about 30% historically. Okay? Wow, right? 30% on the stock. Think about that. So again, if you wanted to do a call on that as an example, you could do a June expiration. I would go to that 55 delta with 2,700 contracts being traded. Buy that single. It's costing you $3,000, maybe make 9 with high probability you're going to make money on that. Okay. But again, you're like, well, that's great, but my account's 5,000. I can't do that, right? So go 24 days out. Do a debit spread. Click on one shaded, the last one. Buy the vertical. Okay, this is a 250 spread you can get for $1.23. So you're risking on one contract. Let's say you got it at $1.20. You're risking 120 bucks a contract, right? So you see how you can still make money on these spreads knowing this big move's coming. Okay, again, I'm going to wait for my actual triggers, but I'm just showing you some high probability trades coming up. All right, let me do one more on these. Let's see, Amazon. All right, so Amazon, blow this up for you. We got earnings on the 27th, right? But what I love is, so right after earnings, I'm going to really look at Amazon because we typically go higher. Look at that. All the way until November. Historically, 32%. So again, what you can do is you can do debit spreads on this every 3 weeks, right? When you get triggers, right? We got a trigger here, for example, right here, made our money. Now we're waiting for the next one. I'm getting a Stoke, not a Laguerre yet, right? So during a seasonal window, you can have several moves, okay? All right, any questions on that? Again, I wanted to have today more of an educational, show you the difference on what I look for based on account size, based on, seasonal. Some seasonals are really good 1 month. So if it's a really good 1 month seasonal, I prefer debit spread, okay? I prefer debit spread. Carl, no, I don't. Nope, too complicated for me. I like things simple. I want to use the seasonal data, the seasonal indicator to show me high probability. So if somebody's curious, I have time for one example here. Give me a stock you want me to look at the seasonal move. We'll see if there is a seasonal move. All right, let's look at Yum. Somebody typed in Yum. Okay, so let me show you from a seasonal perspective first. Okay, I could go to my data mining and give you specific dates from my data mining package as well. But what I'm showing is, so remember, this white line is what price should have been doing. And then we have the spike in November on Yum, and then it's kind of sideways, okay? But then what we're looking at here, let me delete this line. Okay, what I'm showing you here is this is where we're at right now. This is the forecast. So we're forecasted to go higher, okay, from strong seasonal data. So if you draw the trend line from right here, why isn't that working? Let's see. From right here to, let's say, well, we don't want to go the whole year. Let's go to this steep one here, April 13th. Okay. It's telling you over the next 13 bars, which is 13 weeks, we've been averaging a 10% move right now. Okay. So great example. Okay. So now you know you've got a seasonal advantage on Yum. Okay. Now I got a trigger, a more aggressive trigger on that right here. Okay. Right here. Knowing it should go higher. But let's say you're getting in today, which I think it's, I'd wait for a pullback, but just so we can go over the process one more time on this example. Okay, Yum has weekly expirations. Let's take a look at 24 days out. So if we're doing a debit spread, we're buying the vertical. And this recording will be sent out to everybody. So this is finally one we got a dollar spread, right? We're buying the 105, selling the 106. It's giving us a good price as well, right? We want to be 50 cents or less. It's giving us 37. But here's my point. Maybe we want to go 4 weeks out then to give us a little bit more time. Okay? So now I'm going to look at 4 weeks out instead. Buy the vertical. So 4 weeks out is still giving us under 50 cents, right? Under 50 cents for that dollar spread, but I have another week now and time decay won't get me as fast, right? So if I was doing this trade, I would be taking the 4 week out. Okay, so thank you for that example, because that enforces exactly how when people say sometimes you do 3, sometimes you do 4 weeks, that is exactly why. Okay. Now, when you look at the seasonals we were talking about, you say, well, wait a minute, I want to go for that home run. I'm going to do a May expiration straight call. So there's a May 15th expiration. Okay. I don't see a lot of volume out on Yum, but let's just do it as an exercise. Okay. Buy the single. So again, you're risking $278, right? $278 to potentially make infinite amounts. So the dollar spreads are good where you can go ahead and be okay with your initial risk. Let's say you do 5 contracts on that and you risk $600 or $700 to potentially make 1,400 or more, right? With this nice seasonal move coming up on Yum. Okay, start a little bit early, wait for a pullback, then you can take that. Okay. Okay. I do sell credit spreads as well. Not today. I'm not going to talk about that, though. I want to keep it simple. Okay. So hopefully that's useful on how I trade that. Again, if you're not part of the trade alert system, I do have an alert system. I'm focusing on stocks today where you can get text alerts and an email and access to the members area based on the amount of trades that I do. Okay, you're going to get 2 to 3 a week on average. Okay. Okay. One question is on the calls, why wouldn't I take, I'm just trying to keep it simple here, with more delta, and you could. Now, again, the more delta is going to cost you more though, Mike. Okay, that's going to cost you more, and it depends on your account size. A standard procedure, right, is just to go right around at 50% delta at the money. Big picture. Okay, good question. And right now we're offering that 2-week trial, $1.29 afterward. Or if you're interested in, let me just put this into the chat for you all. Let me find the chat box here. All right. If you're interested, give it a shot. If you also decide you want to make the commitment, and let me bring this over and see if it comes. Okay. Oop, I lost it. Where'd it go? If you go to the website, seasonaltraderpro.com, you can go to products or services. You'll see the data mining. You can watch the videos underneath. You'll see the indicators, that we were talking about here. But the alert services, if you wanted to try the stock trade alerts, you just click on it. And when you choose an option, you can do monthly, or if you do the yearly, which is very popular because you get a substantial discount. Okay, you're saving over 40%. Okay, and you can pick or choose. You can do monthly, or you can do the yearly. Okay, if you like the data mining, where I give you key dates. Okay, you can do stocks for bulls, for example. Okay, I still have my launch special, but not much longer. Half off. Again, you can watch the video. So I'm showing you so you can go back. You can go back and watch the videos on what I'm doing here. Okay, again. And one question, which I think obviously is a really good question. I try to get a lot of information here within that 50 minutes here. What about stop losses? So what I do when I'm doing debit spreads, okay, I typically will, if I close at the end of the day down more than 50%, then I get out at the open the next day. Because if you're going to win 8 out of 10 trades, right, using this type of high probability trading system, then you might as well cut your losers at 50% as well. And again, I wait till the end of the day. So sometimes if that doesn't work out, you might be down 60%, absolutely. But I don't want to be in front of the computer all day, and I don't want to put a stop loss in a debit spread. I feel that price tends to reach that. You already know your max loss. You can manage it any way you want in saying that. And then with the calls, the straight calls, again, similar philosophy, except if I get down initially and the move is so substantial to the upside, okay, those are longer term plays for me. I'll keep those. Okay. But with the alert service, I'm more conservative because I know folks that are following me, okay, it's your account that I'm concerned about more than my own at that point. So I'm pretty conservative, big picture on that. Okay, good question. I mean, if you do one contract trades, right, you can certainly start with the $5,000 account. Yeah, absolutely. All right, I'll look at one more. You got me, Cal. HSY. Let's look at it. Okay, so let's first look at the seasonal on Hershey's. Okay. So basically, the forecast was since November, we want to go higher, and we top, that's the white. Okay. And I can make this further back, but I like to keep it right around 16 weeks. Okay. So I would have started looking for longs around November on Hershey's. Okay. And the top is, right here, but let's say the recent top was April. Okay. So November to April. Remember that. Okay. November to April. So now when you look at the chart, I got a trigger right here, right at the start of November on Hershey's, right here. Okay. It was after earnings, had a pullback, made its money on a debit spread. If you did it 3 weeks out, right about here, you're out. On a straight call, you're still in this play, right? You're still in this play. Maybe you eliminated some of your risk, okay? But if you got in here, let's just say to today's high, 6.5% move on the stock, okay? But again, they're always going to work every day? Absolutely not. But what I'm telling you, folks, is knowing this is where the real value is. Because if you wanted to short Hershey's right now, I would say absolutely not. The odds are not in your favor. Okay, the odds are not in your favor. Okay, you're welcome. All right. So again, if you have any questions, support at seasonaltrader.pro. This is actually my cell phone. So feel free to call me if you have questions. I will be tied up a little bit in the next hour, but I'll call you back. And then we have our Facebook page as well, as you can text it. Okay. All right, folks. Well, I hope you enjoyed. Again, feel free to email me any feedback because, or if you have any ideas of what else you would like me to give you, because I told you for 2020, my goal is to educate you as much as I can on some of these high probability trades. And if you have any questions, that's what I'm here for. Okay. All right, folks. Good luck with everything. Take care. And I will send out the recording. Take care. Bye.